Scalping is a high-frequency trading strategy that involves taking advantage of small price movements in the market. Scalpers aim to make a small profit on each trade, so they are willing to take a high level of risk. Here is a detailed risk management strategy for scalpers. Set a risk-reward ratio. Scalpers typically aim for a risk-reward ratio of 1 to 2 or higher. This means that for every dollar they risk, they aim to make at least $2. Use tight stop-loss orders. Scalpers use tight stop-loss orders to minimize their losses. A tight stop-loss order is one that is placed close to the current market price, typically within a few pips. This helps to minimize the potential loss on each trade. Use a large position size. Scalpers use a large position size to maximize their profits. A large position size means that they are trading a larger amount of money on each trade. This allows them to make more money on each trade, but also increases the risk. Monitor the market. Scalpers need to be constantly monitoring the market, looking for opportunities to enter and exit trades. They need to be able to quickly identify trends and patterns, and make decisions based on that information. Use a trading plan. Scalpers should have a detailed trading plan that outlines their entry and exit criteria, their risk management strategy, and their profit targets. A trading plan helps them to stay focused and disciplined, and it also helps them to make better trading decisions. Diversify your trades. Scalpers should diversify their trades by not putting all their money in one trade or one asset. This is a way to reduce the risk of losing all the money in one trade. Have a stop-loss strategy. Scalpers should have a stop-loss strategy in place. This is a way of limiting the potential loss of a trade. A stop-loss order is an order that closes a trade automatically when the market price reaches a certain level. Use a trailing stop-loss. A trailing stop-loss is a stop-loss that moves with the market price. This means that as the market price moves in favor of the trade, the stop-loss also moves, protecting some of the profit while the trade is still open. Don't over-leverage. Scalpers should be careful not to over-leverage their account. Over-leveraging means borrowing more money than you can afford to lose. This increases the risk of losing all your money in one trade. Have discipline. Scalpers should have discipline and stick to their risk management plan. They should not deviate from their plan, even if they are having a losing streak. It's important to note that scalping is a high-risk strategy, and it's not suitable for all traders. It requires a lot of discipline and focus, and it's not recommended for traders who are not comfortable with taking on a lot of risk. Additionally, it's important to also be aware of the broker's terms and conditions for scalping, as some brokers may not allow it or have restrictions. Trend-following strategies are designed to take advantage of market trends by buying when the market is moving up and selling when the market is moving down. These strategies are best used in trending markets where prices are moving in a particular direction for an extended period of time. Here are two examples of trend-following strategies. Moving average crossover strategy. This strategy uses two moving averages, a short-term and a long-term, to identify trends in the market. The strategy involves buying when the short-term moving average crosses above the long-term moving average, and selling when the short-term moving average crosses below the long-term moving average. For example, you can set the short-term moving average to a 10-day moving average, and the long-term moving average to a 50-day moving average. If the 10-day moving average crosses above the 50-day moving average, you would buy the asset. If the 10-day moving average crosses below the 50-day moving average, you would sell the asset. This strategy can be applied to any type of market, whether stock, forex, commodity, or cryptocurrency. Breakout strategy. This strategy involves identifying key levels of support and resistance in the market, and then buying or selling when the price breaks through these levels. A support level is a level where the price tends to find support as it falls. This means that the price is more likely to bounce off this level rather than break through it. Conversely, a resistance level is a level where the price tends to find resistance as it rises. This means that the price is more likely to bounce off this level rather than break through it. You can identify key levels of support and resistance by looking at historical price charts and identifying areas where the price has bounced off several times. Once you have identified these key levels, you can place orders to buy or sell when the price breaks through them. This strategy is best used in markets where prices tend to be range-bound, rather than trending. It's important to note that these strategies do not guarantee success and they are affected by many factors such as volatility and market conditions. Therefore, it's important to always use a stop loss and be aware of the market conditions before implementing them.